everybody, it's Jake and Gino, host of Jake and Gino Podcast here with my co-host, the multifamily mentor, the coach, chef, the father, six, the best-selling author, the G-Daddy, Gino Barber. Gino, how's it going?
Jake, I'm doing good. You know why I'm doing good today, Jake?
Warm me up, baby. What you got?
I didn't have to go through any firewalls today. I just turned my computer on and it worked.
Now you're opening us up to like threats and malware. Thanks a lot for that. You know, the scumbags are going to come out of the woodwork and attack our shit. Nice job, Gino. Nice job.
You're always looking at the negative, my friend. I'm looking at the positive. You're looking at the negative.
Anyways, we got a great show today. We have guests from CTC Capital Management. Their real estate division invests in workforce multifamily housing, predominantly in tertiary markets. And look, they're looking for that value add, the ones in need of renovation. So without further ado, Mark Purtell and Preston Hartsell, welcome to the show.
Hey, thanks for having us. Just real quick, we are not allowed to take on new investors at this time, and any views.
Why, everything's okay, right?
Yeah, everything's great. Everything's great. We just have to get this out there. And any views expressed by Preston and myself are ours personally, not those of CTC.
Well, that's a way to come out of the gate swinging right there. We got the legalese stepping aboard. So clearly we are in safe territories. Guys, let's get this kicked off. Share with us how you got started in the multifamily housing space.
Sure. So CTC, if you look it up, we're actually the background there is a trading company, trading option stocks, futures. It's been around for about 30 years, approaching 800 employees. And then, in 2017, as a kind of diversification play, they started the first real estate fund, which
year? Sorry, what year was that?
2017 was the first real estate fund, and now there's 4 real estate funds, and all focused on workforce value-add housing. We're approaching 900 million in AUM, and in our current investment vehicle, we have $40 million in commitments, and we're focusing primarily on investing in the co-GP side of the multifamily deals.
So explain that for folks that may not be familiar, what exactly that means.
Sure. So co-GP, in a typical larger complex, let's say 100 plus units, you'll typically have a 90-10 equity structure with 90% of the equity coming from a larger LP and 10% coming from a GP or a sponsor. So the LP, they're not going to want to invest in a deal unless they know the person who brought them the deal is also investing in this deal. It's kind of like, hey, if we're in for a pound, you better be in for some portion of a pound. And so with that concept, we understand there's a lot of operators out there who've maybe done deals with their own money or family and friends' money, and they're looking to ramp up their business. And the way to do that is you need more equity. How do you get more equity? Well, you go get a larger check writer to write you a big check, but that big check writer needs to see some piece of your own skin in the game. So a lot of these operators we work with, they're great at finding deals. They just don't have the capital to attract that larger LP. So they can come to us and say, hey, you guys will come in as part of the GP. And we do. So we'll come in for up to 95% of that GP. So at the end of the day, the capital stack looks like 90% from the LP, 9.5% from us, and about 0.5% or so from the GP. So it allows that operator to go in and run a much bigger deal, get much bigger fee income, get a larger piece of promote dollar-wise in the back than they would have had they stayed with a smaller investment vehicle.
Yeah, no, I was going to say, so give us a real-life example where you guys are Big Daddy Warbucks, you're coming in, you're identifying a great operator. Give us a real-life example of a recent deal that you did and how it went and how that played out.
Sure. So a recent deal we closed on, the total raise was right around.
And how you identified the operator and what that process looked like, because I think that's what a lot of folks are going to be interested in. Yeah.
Sure. I mean, the way we find operators is the way operators find deals. We network, we reach out, we go on podcasts like Jake and Gino's, and from there we go out and we make connections and we look for operators to bring us deals. And saying, hey, look, here's a great deal. Here's why I like it. We run it through our own analysis.
And how do you vet the operators?
We really look at the deal. We start with the deal. And if the deal makes sense, then we start looking at the operator and going, okay, what type of track record do you have? We don't need to see a 20-year career, but we do want to see some type of business acumen to say, hey, look, this operator can go in, buy a property, renovate it, get the rents up to market, and execute on the business plan. So that's our general thesis for vetting operators.
And carry on with your story. You're going to share a recent transaction. Yeah.
Sure. So, recent deal we did there, total raise was right around about 6 million or so, and we came in for right around $1 million of co-GP equity. That operator went out then and sourced the other 5 million, knowing that they had about a million in the bank. At that point, the operator, they close the deal and then they run it. And we are not pref equity. In fact, we don't even want to see pref equity in deals. Our equity sits alongside every other equity dollar in the risk capital stack.
Preston, what does a deal look like to you, and what markets are you guys investing in?
Currently, we're really big on the Northeast and the Midwest, those being for two reasons. One, there's not a lot of construction there. We stay away from a lot of the markets with construction. One, because with new construction comes rent concessions, us being in the more B2C class workforce, when new Class A has big concessions, that really narrows the gap on our affordability. So people will go to these Class A buildings, they'll get the concessions, and they'll come back after a year to what they can originally afford, but we're losing a year of occupancy there. Another reason we like some of those markets is some of the more steady incomes. A lot of these more southeast Sun Belt markets, great with population growth, but they do not have the income to support the value add model. And while $100, $200 a month in extra rent is not a lot to most people, when you consider after tax dollars, a lot of the median income of those Sun Belt markets, that does move the needle. Whereas we've seen more steady incomes in the Rust Belt, Northeast, and Midwest.
So Gino, I want to dive into this a little bit because I find it interesting because I think it's clear that there's been a huge push to the Southeast and the Midwest. Are you seeing less competition in tertiary markets in the Rust Belt in those areas? Is that also, are you seeing higher cap rates, potentially less demand on the, from an investor side? Is that sort of your play here as well, or no?
Absolutely. There's definitely less transaction volume in some of those northern markets. Kind of going back to the whole population growth and migration to the Sun Belt and Southeast. That's where there's a lot of building. There's a lot of transacting there. In the Northeast, yeah, I think it boils down to there's definitely a little bit of a less competitive market.
The other thing too to add to that is the Sun Belt, obviously huge interest in the last couple of years with population migration, just overall demand for that product down there. The cap rates got really low there, whereas in the northern states you didn't have that cap rate compression that you saw down there. So when interest rates rose, the southern markets were playing a lot of catch up, whereas the northern markets were already at a 5, 6, or 7 cap.
Mm-hmm. And what is your exit strategy on these deals? You want to hold them long term, refi them, sell them? How does that look?
Our hold times are anywhere from 1 to 10 years. We're very flexible in terms of hold time. We're really looking for an IRR type return, so we're not coupon clippers. But at the same point too, we want to see the debt line up with the hold time. We've seen a couple situations where an operator goes and buys a deal, and they go, "Hey, we're going to use bridge loan for 2 years, and then we're going to refinance to perm, and then we'll hold that for another 5." The issue that we have with that is that now you're trying to line up the deal to match interest rates, to match a changing environment. Obviously,
there's not much predictability there.
There's right. So we'd much rather see a loan term that matches the business hold time. So if it's a 5-year deal, put 5-year debt on it. 7-year deal, 7-year debt. 2-year deal, 2-year debt. That's fine. So
how are you guys able to influence it though? So you're co-GPing, and I don't have experience doing that. So I'm just wondering, do you have control? Do you have decision making ability? Is it a vote type thing when you're looking at the hold time in these deals?
Generally, when the operator brings us a deal, they'll have a hold time in mind. That kind of gets shuffled around when you bring in an LP. If somebody's writing a check for 90% of the equity, they ultimately will get major decision rights, including exit timing. So,
so you have some level of control, or at least voting capabilities in these offerings. Yeah,
you do, in the sense that what the business plan is going in, and at a certain point too, though, you got to trust the people you're working with and hope that they're all going to work with you and stay to the business plan and hold time. Yeah.
Mark and Preston, both of you, what are some of the risks that you guys are taking on as you're doing these deals with other operators?
Early on, before the deal closes, there's oftentimes pursuit costs, earnest money that could be either refundable or go hard prior to
Are
close.
you participating in that?
We will, with an operator who we've done multiple deals with. Yes, we will take on that
How
risk.
many different operators are you working with currently?
Right now, we're working with a handful or so, but our list that we're talking with is in the hundreds.
Yeah.
Wow. Okay.
Any deals? Any operator deals that have not worked out, and how'd you handle that?
Usually, and if a deal starts going sideways, the first thing we'll do is reach out and have a conversation with that operator. We believe that communication and open communication and analysis of a problem at the start can help head off any type of major issues down the road. So we'll lean on our own experience and kind of give some advice and guidance to that operator to say, hey, look, we're noticing renovation pace is slowing down or occupancy is dropping. What can we do to get ahead of this? Because we don't want, there's a big difference between 90% occupied and 80% occupied. A lot of times that can mean the property being break even cash flow versus not break even. And so we try to get ahead of that as much as possible. I know, Preston, you got anything to add to that?
Yeah, some risk we take on with the co-GP model is just working with emerging operators as a whole. Sometimes they're one-man bands. Sometimes, they'll have 5 people and have some asset management team. But on the downside there, they also have a larger payroll. So if they're not doing deals, getting fees, sometimes we'll see an asset management guy leave, and then you can see that flow down to the deal level with the property management team not being on top of it, renovations not being done in an orderly fashion. So I would say just at a whole, emerging operator plan that we have is not always as smooth as you think.
Mark and Preston, I'm going to take you back to 2017. And you guys are the ones that have made multifamily crazy. Prices and assets going crazy. Why didn't you stay in your own lane? Why'd you have to come to multifamily for? I mean, what made you shift over from what you guys were doing to get into multifamily?
To be clear, this is kind of more of a spin-off, if you will, of the trading entity. So the trading entity is still very much alive and well and going strong, and this is more of a new business line to complement it.
You guys, how did you see the opportunity? What was the opportunity in multifamily? Because it's a completely different thing than trading options and doing all that stuff. This is real. This is hands-on people. You can't push a button. You've got to spend a lot of time, longer time horizons. What did you guys diagnose?
What do you see in the space?
Yeah, I'm sorry. I'm trying. Yeah, exactly. What was the opportunity that you saw?
Depending on the article you read, and there's one every year or so that comes out, the U.S. just doesn't have enough housing. There's anywhere from a housing need of 4 to 10 million units over the next 10 years where it's going to fall short. And where we find the value add and why the draws to this workforce housing is that you cannot build a $100,000 unit brand new, but you can buy one. And you can buy one and you can provide a quality living conditions for these tenants. And you can also go ahead and create a world that works within this community that wants tenants to come there. But at the same point too, for our investors, it allows us the ability to go in and create returns because once again, there's a limited amount of these $100,000 units out there. And so by buying these and holding them for the whole time, you're effectively building into that demand for that product.
Mm-hmm. Where do you guys see the opportunities going forward in the next 3 to 5 years as this market cycle starts to lengthen?
I think we're still going to stick with the thesis of low construction for a lot of reasons. One, like I mentioned, the concessions earlier. Two, just the overall units in the market that pushes vacancy as well as rent growth. If you are looking at it, most underwriting models, if you put rent growth to 1-2% in the first 2 or 3 years, that's going to hammer the IRR on a return level over a 5-year or 7-year hold, especially with our exit strategies.
And Mark?
Yeah, I mean, we're really looking for a strategy where we don't just base on a cap rated exit to drive the returns. Kind of like Preston focused on there with rent growth. The other thing we're looking at is pro forma rents. We want to make sure that those rents are not only achievable relative to other comps, but also affordable to the median income earner. So, if we see a deal where, hey, rents right now are $1,000 and then go to $1,700, even if the comp support, if the median incomes and average incomes in that area don't support $1,700 rents, we're not going to underwrite to that. We're going to underwrite to, $1,300 or $1,400, and then if the deal starts to pencil at that point, great. Now we'll take a harder look at it.
Like that. So that's your buy box. We have buy right, finance right, and manage right. That is our 3-step framework. You want to lean into a little bit more of what your buy right sounds like and what it is, so then anybody listening to this is like, yeah, I want to work with these guys because they really align with us.
Sure. Kind of what Preston mentioned, we're looking at supply in the market. We don't want to see a bunch of new deliverables coming to the market, even if they're not competing directly with our B or C product. Maybe it's a luxury class A product. We want to make sure that there's a limited amount of supply in the pipeline and also being delivered. We're also looking at vacancy, very similar to the new construction story. If there's a high level of vacancy in the market, it trickles down to B and C product, regardless if it's high in the A class product. As far as the affordability, we touched on that already. We're looking at median and average incomes. And then finally, we're looking a real high level here at the amount of comparables of similar product. We don't want to see, if every unit's at $1,000 and they're renting there, and that's great, and there's enough supply at $1,000, you're not going to get $1,200 for your unit. You'll be lucky to get $1,000. There's a ceiling in place, and we have to respect that, given that's where the market conditions are. To take it one step further, oftentimes we'll see cap rates that are artificially low because it makes the returns look good. It's really easy to take a cap rate from an exit from a 6 to a 5, and hey, we just boosted your IRR by a couple points. Well, why don't we move it from a 6 to a 7 and see if the deal still pencils? Because, as we've seen a couple of years ago to today, cap rates have rose, and it'd be not very prudent to you and your investors if you're underwriting lower cap rates in a world where, to be conservative, they should be higher. Even if you don't think they'll be there, from modeling a standpoint, you should run them higher at exit.
So I'm looking at this. I want to talk about some specific markets, because the thing that sounds a little scary from my perspective is that if you have population flatlining or declining, no construction, I feel like over time that could lead to higher vacancy. But I think there's also probably a few select markets in the Northeast or Rust Belt where you're probably seeing like a flat to slight population increase, but low construction and probably a constant vacancy. And like the first thing that popped in my head was probably like Buffalo, and maybe I'm off, but I'd love to hear, you guys elaborate on this a little more, because it seems like you may be finding a little bit of a sweet spot where you're seeing like a stagnant population, low sort of economic growth, but an opportunity because there's like no new construction coming on, keeping the vacancy rate in place. So can you guys outline a market or two where you're seeing this type of scenario?
Yeah, we really like upstate New York. Matter of fact, we've looked really hard at Rochester. We like Buffalo. I think
Careful
our last
about
deal was-
Rochester, though, man. I'm from that area. Okay, that's like the Wild West. MFers getting shot up there. It's getting dangerous. They got terrorists and stuff. You gotta be careful, man.
You don't want to get Jake. Jake sounds like he's scared. You're never scared.
I'm scared. I ain't going downtown Rochester no more, man. I'm just messing with you guys. It's I grew up in that area, so go ahead.
Oh, well, good to know. But yeah, our last deal was actually outside of Albany, New York. Like we said,
that's a little
low
safer. You got like Dave
low
Matthews,
vacancy.
hippies hanging out up there, going to SPAC. You maybe a little better shape,
Yeah, fair enough. Also, one thing we liked about Albany, it's the capital. The government's not going anywhere. Stable jobs, stable incomes. Good story to push rents there. So yeah,
you guys do anything Buffalo or no?
Not currently.
Not currently. So you got you do anything? Did you do deals in Rochester or no?
We looked at two pretty hard, but we ended up going with the Albany one instead.
Yeah. Anything in Syracuse or no?
I don't think we've seen anything.
Yeah, not since I've been here.
Gotcha. So what other markets though that are kind of like fitting this scenario for you? Any other markets that you guys are liking right now?
Your Midwest markets, a couple things, just the amount of syndicated deals that came out of there are much lower than some of your Sunbelt states. So, markets in particular, Des Moines, Kansas City.
Kansas City's hot right now.
It is. Especially.
You got to draft on that Taylor Swift effect. You know what I mean? Get a little bit of that. Increase the NFL about brand value $330 million. I saw the other day. So maybe you guys get a little piece of that Taylor money.
Yeah, um, yeah. The downtown market definitely has some more competition in there, but when you get in the suburban markets, kind of like Indianapolis too, there's definitely a supply demand imbalance that we do like.
Property management companies, when you guys are dealing with them, what challenges have you had with operators? Because it seems as if the last couple of years, everyone's been buying deals, but the management, the operations side has slipped. How have you guys been able to hold these operators to account and make sure that they're managing these properties properly?
The one trend we've seen with a lot of operators that we worked with is when they're starting out, they're in growth mode, they're looking to do as many deals as they can, and the natural inclination there is to use third-party management. As these operators get a little bit more scale, and obviously we've seen in 2023 deal flow has slowed down, so acquisitions aren't happening as fast, forcing these operators to take a look at their own operations. Well, what we find is as operators get enough scale, what they end up doing is they start to self-manage their own properties. So
Mhm.
now they take on the property management aspect not necessarily as a revenue source, but more as a defensive measure, and to have better control of these properties. So that's the general trend we're seeing with every operator we work with. Start with third party, eventually migrate into self management, and we find overall it's a much better operation. Is now you have total control over staff, you have total control over costs and any type of repair work done. Your capex is more in line. So that would the general migration in life of a owner operator.
And Mark, last question before we go to the short answers. Are you guys getting on what we call like weekly calls with property management companies? Are you asset managing this deal? How deep do you guys go into operations of every one of your assets?
We definitely see, obviously the quarterly financials, and we'll have monthly or so check-ins with these operators. Obviously, if there's an issue, we're always available and very responsive. But at the same point too, we want to don't want to smother these operators with telling them how to do their job. We look at these operators as experts in their market. We look at them as the boots on the ground that are running it. We definitely look at our role as equity. And so, although obviously everybody wants this deal to do well, we don't want to overburden these operators. If the deal is doing well and they're telling us, hey, we got to cut rents a little bit or offer a month of concessions to, because it's a slow season or whatever, we're not going to argue with them because we trust that they know more than us.
All right, guys, let's take a quick time out to hear from our sponsor.
Now, we have had a great run in multifamily, going from 0 units to over $250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework, buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily.
All right, we're back. So 2017 sounds like you guys got the ball rolling here. How did you scale the operations? What's a key to starting from ground level and scaling up to? It sounds like you guys are almost at $1 billion in AUM. Is that correct?
The real estate side is approaching a little over 100 million right now.
Oh, 100 million on the real estate
Yeah.
side. Gotcha.
Yeah.
So how did you guys start though, from like entering that market and then scaling and getting a presence in the space?
A lot of it just started with one deal, one operator, one deal, and then from there, networking, just continuing to pound the pavement. Unfortunately, there's no easy answer. You can't just go to Google page one and say, "Hey, I'm looking for a great real estate deal," and there it is. It's a lot of just outreach, and we've refined our own systems in terms of deal tracking, in terms of underwriting, in terms of response time. So the last thing we want to do with an operator is to string them along if the deal isn't going to pencil, or we're like, oh, we're not sure. We don't want to be half in, half out. Preston, what's our turnaround time right now on when operator sends us a deal?
I would say we can either kind of cut or go to the next level with 80% of the deals within a week. give them a hard no, or hey, we want to have a follow-up call, we want to meet you guys, because a lot of the times we'll get it from the broker, so we got to go through them to meet the syndicator or operator.
Yeah, and the clock is ticking, so it's going to be hard for you guys to do repeat business with an operator if you're stringing them along and then you screw their deal up because they're counting on you for the money. So I think that's a really, speed is crucial early on in the the deal finding for sure. Anything that you guys have read or any type of books or podcasts you guys listened to lately that have added value? I know you just had NMHC. Anything that you guys want to share with the folks?
One thing we do is we do subscribe to all the online news articles, and so by reading on different articles, different opinions, different you form your own opinion of what's going on while staying current with investments. As far as any books or recommendations, there's good books and there's bad books. I can't really tell you here's the book you should read, because everybody has a different strategy in this game. So I would say read as many as you can and take the best pieces of advice you can out of them.
Yeah, and I will say this: I think it's innovative what you guys are doing right now. I think you're going against the grain because the push is Midwest, Southeast for most groups, kind of following the population trends. So I think there is an interesting opportunity there for you guys to execute on for sure. Any project right now that you're excited about that you want to share? I know you just got the Albany deal done. Anything that you got in the hopper right now that you're excited about?
Right now, it's kind of slow, as you know, with transactions. We continue to see deals every day, and when the next one hits, we'll be excited about it. But right now, we're still working on a couple different pieces.
You guys looking more for like loan assumptions right now, or waiting for rates to go down? What are you thinking about?
We try not to play the interest rate game. We look at ourselves as real estate investors, and we look at debt as a tool, much like you look at insurance or property management, as try to have a cost of the deal. So that kind of ties in earlier with the whole time lining up with the debt terms. So we're not one to make predictions on interest rates. We're just looking at it as a plug figure and figure out how to manage that debt as best as possible.
Yeah, it's an interesting time right now because we don't like doing anything with floating rate debt. So the only way that we found to execute right now is we're actually just doing recourse debt with local regional banks. So we're fixing for at least 5 years. May not like the rate, but a lot of times if you refi out, there's no prepayment there. So it at least provides an opportunity to do transactions and not get into some variable rate debt that could really hit you hard. I think it just sometimes makes it harder on the syndication side of things if you have other investors that are specifically looking for non-recourse. That's the only thing that can kind of mess that up at times. But G Daddy, what you got? You want to take us home?
Well, CTC gets into the business in 2017, and they're to blame. The real estate market's going crazy. Multifamily is blowing up, and it's a good thing. And I think Mark reiterated why it's an amazing vehicle for anybody out there listening. It's a basic human need. It's food, clothing, and apartments. You need a place to live. Demographics show that housing, people do not see it as the American dream as they once saw it. It's really cool to get a key. Next year you're living in a different city. So I don't see it going away as well. And I love their model of going into basically being the contrarian, going into these markets that may not be these high flyers. They've got nice, stable cap rates. They're looking for these assets that appear in those markets to cash flow really well. They've really dialed into what their buy rate criteria is. It's always nice to have someone on when you ask them their buy rate criteria, they can actually, list it out, because most people are like, I don't know, we're just buying deals. But at least they're focused on the type of deals that they're buying, know what they want to buy. And for anybody out there who is an operator or a syndicator looking for someone, looking for capital, looking for balance sheet, reach out to Preston and to Mark, and they will help you close that next deal.
Possibly. You can put asterisks by there. We got to get legal involved. Guys, what's the best way for folks to get a hold of you?
Sure. You can check out our website at ctccapitalmanagement.com. You can also email us at capitalmanagement@chicagotrading.com, or you can always call us 312-863-8079, and we'll answer.
They're going to pick it up. Guys, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He's the G Daddy, and we make it happen. We'll see you next time.
Thanks, guys.